Mr. Mark Selby, how are you, sir?
I am very good, Mr. Matthew Gordon.
Glad to hear it. You've been up at Timmins, haven't you? Visiting
I
a few
was,
people.
yep. And Tuesday morning, there was a little bit of snow on the ground. Fortunately, it did end up melting, but winter in Northern Ontario lasts a little longer than it does in a lot of other places on the planet.
Wow. Okay. Well, it was great seeing London last week, by the way. Fantastic and really good conversation as well. I thought I was going to pick up on some of those components. We talked about 3 talking points, really, last week. Why don't we sort of start with the first of those, which is obviously nickel price.
Yeah, I think one of the key takeaways was, that these next few weeks was really going to be pivotal. There was a sort of a few trends that were kind of coming to a head. So, first off, copper had collapsed down below $4 a pound, and nickel had held up at, above 22,000 or $10 a pound. It felt like it was going to go through it, and we said there's a likely chance that it was going to go through, and we did see it go through, that $22,000 a ton level. The next support area is really around 20,000. We haven't been through that number in 2021. For those of you who've been watching this for a while, I thought we were going to get through it back in the first half of 2021, but it held up. It held up pretty well. And again, I think if we do break that number, I don't think we'll be through it for very long. We can talk in a bit about the cost structures. A good little piece done by Macquarie analyst, just really surveying the cash cost of the various nickel operations recently, and there's not a lot of room to fall before another big chunk of production would not become cost positive. So again, like a lot of things in metal prices, you have some sharp moves and then you trade sideways for a while. I think we will trade in this $20,000 to $23,000 a ton range. We'll need to see either China's overall recovery, see some clear signs that it's actually happening more, broadly across their economy. The pickup in battery demand, we'll talk about. That was one of the key things. We are seeing the first signs of that, so that's good. Or that the U.S. government's finished raising interest rates. So one or more of those will happen in my mind by Q4. But for the next little while, we will test that lower level of the range. But I think we'll be now a little bit range bound on the nickel front.
Right, so it's kind of interesting with regards to nickel prices. A few elements that are driving up price, and obviously the cost inputs. There's things like coal. The fact that we're not, people aren't seeing as much on the cobalt side of things as on the credits. Do you expect these things those things to kind of level out, and how much of a big variable will they continue to be going forward?
Yeah, so coal is a huge part of costs for nickel pig iron. So if you look on that, look at the data that's happened for some of the companies that disclose it, you've seen a pretty sharp rise. Coal prices have come off a little bit, but they're still at pretty elevated levels. So you're going to see a little bit of that cost pressure come off. But, that's the part with these nickel pig iron plants. There was the big thing was, they're cheap to build and they're cheap to operate. And the reality is we're seeing they're not necessarily as cheap to operate as originally advertised, and particularly again with NPIs where you're seeing a discount in the price. So that margin that some of these operations are making, are pretty skinny these days. So you will see some improvement in you've seen improvements in salt, and then on the other side are the HPAL projects where you need the key inputs there are sulfur. And a key offset to the cost is the cobalt price. And so sulfur prices have peaked. There was a bit of a squeeze that went there. So they've come down. So that'll help the HPAL producers, and that will improve in the short term. I think the piece that is going to continue under pressure for the next year or two is cobalt prices. These HPAL projects, as much as people talk about them in the context of nickel, the reality is the ratio of production at those assets is usually of the order of 10 to 15 to 1 between nickel and cobalt. But then in terms of the global market, nickel is about 25 times larger than cobalt. So it'll have a disproportionate impact on the cobalt market. And we are really seeing that now. Indonesia is now the largest second largest cobalt producer globally, and that's going to continue to ramp up pretty quickly over the next time period. So, that'll have some impact on the profitability and the cost structure of these HPAL operations.
It's interesting that most people kind of forget about the interplay between the different commodities. Certainly with steel, which has a multiple of feeds going in there. Even we think we talked about last week was the kind of lithium and the lithium plays out there. That in its own way has an effect on what's going on here in terms of the sort of restocking of battery metals as well, doesn't it?
Oh, for sure. I mean, that's something I've been saying for the last several discussions, is that with the collapse in lithium prices, that's caused that entire battery supply chain to destock. And so it's the impact of what's happening in one metal is then spilling over across the sector in terms of all of the other battery metals. The good thing is, and as I said, this was one of the things we highlighted as one of the things that seemed to be pivoting. We had seen a sharp rebound in the last few weeks in lithium prices. And so what was interesting is in a lot of the, you're getting quarter end conference calls right now. And so a number of the major lithium players are talking about the fact that they've seen a significant pickup in the last few weeks. So I think that battery restocking cycle has now kicked in. And I think, that's what's going to, continue, will drive us through the end of the year. The question will be for nickel, as it's got its stainless steel base as well as its battery base. And so with the nickel price coming off a bit, that's going to cause some destocking on the nickel on the stainless side. So we'll see how those play out. But again, I think by the time we get to Q4, everything will be heading back in the right direction, and we should see prices move back up again.
Right, and I guess there's a kind of the way that this restocking works is a kind of reflection of how the equities market is behaving as well in terms of this kind of stop-start motion that we're seeing, despite the burgeoning narrative around the EV components, certainly about battery metals more broadly. So how do we retail view the market going forward in terms of these demand surges and then this kind of resetting, and the general trend is still up, right?
Yeah, no, that's the key piece. When you have when you have these long major trends that are heading in one direction, when you get these destocking cycles in the midst of those large to long uptrends, if they feel like especially painful because that the underlying business is continuing to grow. The thing to remember and the thing to, again, if you believe in the trend and the theme, stay invested, because if you try and time it, when these restocking cycles happen, they can be absolutely face ripping, steep cliffs. And generally after a period of destocking, the liquidity and everything in that area has dried up. And so once you get to see some incremental buyers come in, you can see, again, the prices of commodities and the price of the stocks really start to rip. Again, I don't think we'll see that until, later this summer, early fall, but I can't tell you, it could as easily happen in 3 weeks from now as it could be in 3 months from now. So,
right. And then you kind of felt that case, I think you referenced it earlier in this conversation, was obviously INSG monthly data is out. We've referenced it a lot in our conversation. So that, do you feel that they are capable of keeping track of the kind of movement and momentum in the space? We've seen, we've talked in the past about analysts having been so far wrong and so far removed from the demand numbers. Groups like INSG keeping up with the pace.
Yeah, I mean they do a good job of tracking data historically, but again, they're relying on stuff being reported, and there's a long lead time. So there's in the more recent months, there's a bunch of estimates in there. The thing I find interesting is that they are talking about large surpluses, and again, we thought the first half of this year was going to be sloppy because there was still a bunch of NPI and MAT to get through, but the interesting thing is, they're showing substantial surpluses, but we're yet to really see, inventories show up anywhere. And again, part of it is, some of these can't be delivered publicly. There's whispers of inventories here or there, but again, it doesn't feel like the market is completely sort of overflowing with material, and so I think a little bit of it is, they may not be picking up some of the demand from new battery capacity coming online. And as I said in some of these discussions before, when you have a new plant come up, you have a whole supply chain that needs the first fill of inventory. And those numbers, because they track how much that plant uses, they really don't pick up that first fill of inventory. And so in these kind of emerging new industries, you can have demand effectively undercounted for a period of time. So it feels a little bit like that. The other piece structurally there is when you look at the cost structures, and again, Nickel Industries does a good job publishing a lot of detail on the costs of their operation. So if you really want to understand what the cost structures and then nickel pig iron look like, I would encourage you to read their MD&A. But in those things, you can see very quickly, basically ore, coal, power is 90 to 95% of their costs. And those are generally variable costs. So it's a little bit perverse, if you can't sell it and your costs are variable and you don't have a huge fixed cost base that you're trying to amortize, it doesn't make sense to maintain production in the face of that. So we'll see. I mean, again, it'll take another 3 or 4 months to see things get all cleared out. But the big piece is, with this rebound in the battery destocking, with LME prices coming down, at the beginning of the year, I talked about this great compression coming back again. So seeing the discounts for the various intermediate products starting to disappear, LME prices down relative to where they otherwise would be, kind of feels like we're in the first few innings of that, and we'll sort of see how that translates over the next few weeks. Again, I didn't expect that to be completed until the end of this year, first half of next. But hopefully we're well on our way there to kind of normalize metal prices, across the nickel supply chain.
Okay, and then with you get something you referenced earlier was obviously the piece from the Macquarie analyst. Again, we've talked about a lot in the past. I mean, what else did you get from that report in terms of downside price risk, etc.?
Oh, I think that's the thing that's shocking to me. Seeing sort of one-off things, but seeing sort of everything together, realizing just how much of production is sitting at $16,000, $17,000, $18,000, $19,000 per ton, making products that are selling at a discount to the LME price. And so that should give investors a lot of comfort that the downside risk here is still relatively limited. And we've talked numerous times of what the upside potential as this EV transition goes underway, what it could look like.
Okay, well let's talk about a little bit of company news, because I think there's a couple of instances that might be worth pulling up. And we were talking before the show about one of them about restarts. So what's the news?
Yeah, so in nickel, there's not necessarily a long list of closed down mines that can restart. One of them, Avebury, is now in a company called Mallee Resources, which will be going public shortly. They had hit a few little bumps before they could start trading this week, but they're on the restart path. They are going to be publicly listed, and restarts are one of those things where these are sometimes the stocks that you make a 50x on. In those situations, generally what's happened is the mine, there were some specific problems. You have a new management team come in that knows how to address or fix those specific problems. And then if they get the timing right in terms of, okay, the mine closed down when copper prices were 60 cents and now copper prices are $3, you can get sort of a double lift on your stock. At the same time, there's a number of these things, and there was another story this same week, and which is why I thought it would be pretty timely to have this kind of discussion around production restarts. Is there's a mine called the Minto mine. It was owned by Capstone. It was, I think, a junior before that, and it's a mine that's really never made much money, and it's really struggled. And so, not surprisingly, in its third or fourth incarnation, it's once again in insolvency. So there's several examples of that. So I would say, if you're an investor, do your work to make sure that you're comfortable with whatever the issues were when that mine closed, that this new team has a plan to address those, because you can't necessarily count on the commodity boom, the commodity pickup. And then, again, make sure you're buying something that's facing, has a tailwind behind it, as opposed to a headwind behind it, commodity wise. So, with Avebury, the issues were arsenic content in the concentrates before, making them not particularly saleable or only saleable at a large discount, and then struggling to get their operating costs down to a level that made a lot of money. So, there's kind of three paths here is don't, if you're not used to taking a lot of risk, then don't do it. B, do you, if you're technical enough and feel you can understand what the management team's trying to do vis-a-vis those technical risks, then, take a look at it. Or you can wait until you get through a few quarters worth of production to see whether you're comfortable in terms of things heading, in the right direction on that front.
Right. I mean, it's always a difficult one. Situations like this are very difficult for retail to wrap their head around, because, you've got seemingly similar situations which could have polar opposite outcomes. And I agree with you. If you do your homework, one, you've got to make sure the management team are, hands up going, these are the issues which we face. This is why it shut down last time. And it could have been, if it's something as simple as, copper price, then you got to, have a view on, what do you think the copper market's going to do, or nickel market is going to do. If it is something technical, you've got to be sure that the solution that they're offering up has been used elsewhere, and we're not dealing with, say, a new technology which is all of a sudden going to change the fortunes of not just this company but the whole industry. I don't invest in new technology generally, because there's absolutely no proof that it works. And again, that just. And I'm with you. Generally would avoid these situations unless I felt the management team had been there and done it before themselves, and they've got the people on board with a plan which they clearly articulate and can talk you through. And I'm with you. I'd wait a couple of phases before throwing any money at this thing. You may lose some of the upside if it goes right, but you're more than likely to not lose money by not putting your money in too soon, because it doesn't always go right. Right. Okay. Great topic, and probably one that we talk about in any commodity and any space. Let's leap on to FPX Metals. I think they're having a good time out there, aren't they?
Yeah. So again, another good release from the company. So again, they're developing an ultramafic nickel deposit. It's made up of a mineral called the wallrite, which is a nickel iron alloy. Again, highlighting some of the benefits of the ultramafic deposits. Like we have a Canada Nickel. Because of the way these deposits are formed, they're often very simple from a mineralogical perspective, and so they were able to produce a battery grade sulfate. With a simpler hydrometallurgical process than you would typically use for a higher sulfide nickel deposit, that sometimes, because you've got a lot of sulfur and a lot of fluid, sometimes you end up with some other parts of the periodic table in the minerals that you're trying to process. And so, you may need to take that concentrate through a smelter and refinery as the only way to get it, or it makes the hydrometallurgical process a little more complicated. So, good to see a solid result come out on that front, and again, sort of, help make the case for the ultramafic deposits in general.
Good man. Okay, Mark, we'll see you next week.
All right. Thanks, Matthew.